The broadest and most general definition of investment that I can think of is a current sacrifice for the purpose of obtaining future benefits. According to this definition, you are investing, obviously, when you buy stocks and bonds. You are investing if you deposit money into an FDIC-insured savings account. According to this definition of investment, you are investing right at this moment. Why? Because you are sacrificing your time, your energy, and your money to watch this video, to complete this course, to get a degree from the University of Maryland. Why? In order to obtain the benefits down the road, a high-paying, cushy job or something like that. Now, the current sacrifice that you make is called the principal. Note the spelling of principal. That ends with an AL rather than an LE. The future benefits are known as the return on investment. So, with an investment, you sacrifice the current use of the principal in order to obtain a return on investment. Your primary investment vehicle, other than the owner-occupied home, will most likely be securities. Securities come in two flavors: bonds and stocks. Bonds are nothing more than IOUs. They are nominal assets. The buyer of a bond is lending money. Bondholders are lenders. When you lend money, you are providing a service. That is, you are allowing someone to have something now rather than making them wait. And it is a service for which they will pay. When you own a bond, the return on investment is the interest that is earned. You are earning the interest despite the fact that you are not grunting and sweating, because you are providing a service to someone. It is money that is earned despite the fact that the IRS calls it unearned income. The stockholder, on the other hand, is a part owner of a corporation. Corporations earn profits from the goods and services that they sell. So like the bondholder, as the owner of a corporation, you too are providing goods and services. Although you don't do a lot of heavy lifting, you're not scraping your knuckles, you don't have to commute. You are also, as the owner of the corporation, adding value to a pile of resources, just like the carpenter adds value to a pile of wood and hammers and nails and glue by taking all of that stuff and making a table out of it. The profits that the corporation earns are distributed to the stockholders in the form of dividends. So the returns to stockholders are dividends. Now, there are some stocks that do not pay dividends, and we will see later why people will buy those stocks. But in both cases, stocks and bonds, the owners of these assets are also gamblers. And so their winnings, their return comes in the form of gambling winnings. And here, of course, I'm referring to the essay in Module 1 entitled Getting Rich Slowly. This essay talks about the ways in which you earn income. The owners of bonds and stocks are gamblers because both bonds and stocks are traded in secondary markets. Now, we'll talk about what that means in just a second, but the implication is that the value of the asset might go up or might go down. Actually, we hear more about stock markets because stocks are much more volatile than bonds and seemingly much more indicative of the direction of the economy. So don't let any of the detractors of capitalism or the socialists say you don't deserve the income you earn from an investment. You deserve it because you earned it, even though you didn't actually work for it. You are still making a productive contribution to the society simply by owning these assets. You're providing a good or service, you are adding value, and you are taking a risk to do so. Now, when I look for an investment opportunity, I am not looking for the opportunity with the highest return on investment. Instead, I'm looking for the opportunity with the highest expected, real, net, average annual rate of return on investment. Now, that's quite a mouthful. But you need to know what each of these terms means and why it is important in order to find the best investment opportunity for you. So let's look at each of these terms individually to see why each is so important. Just a few seconds ago, I mentioned that I was not looking for the investment opportunity with the highest return on investment. Instead, I was looking for the investment opportunity with the highest expected, real, net, average annual rate of return on investment. Let's see what each of those terms mean, and let's work our way backwards, starting with the rate of return on investment. I'd rather have an investment with a higher rate of return on investment than one with a higher raw return on investment. Let's see why. Suppose that I were to invest $100, and 1 year down the road I would get $110 back. That is, I would get my original $100 of principal returned to me, plus $10 in winnings. Now that $10 in winnings, that is my return on investment. But now let us suppose that there is another investment opportunity where I could invest $200, and instead of getting $10 back, I could get $12 back. Notice the return on investment for the second investment opportunity, $12, is more than $10. But the return on investment per dollar invested for the second investment opportunity is lower. It's a $12 return on a $200 principal, which is 6%, whereas in the first case, there is a $10 return on a $100 principal, 10%. So if we look at the ratio between the return on investment to the amount invested, that is the principal, it will tell us the return on investment per dollar invested. Now, if we shrink that term ratio down, we get rate. The first investment opportunity had a higher rate of return than the second. So what this term, rate of return, is telling me that if I had $200 to invest, don't buy 1 unit of the second investment opportunity, that is, invest 200 to get 12 back. Buy 2 units of the first opportunity. That would mean $200 would return 20. So my rate of return would be 10% rather than 6%. For that reason, we are seeking the investment opportunity with the higher rate of return on investment. Okay, we have just discussed the reason why we need to consider the rate of return on investment rather than the raw return on investment. But notice, what we ultimately want to make our investment decisions upon is the, let me say it again, expected, real, net, average annual rate of return on investment. So let's now consider the term average annual rate of return on investment. Average annual. Let's consider 2 investment opportunities. Call them investment opportunity A and investment opportunity B. Suppose investment opportunity A would pay us a 50% rate of return on investment over 10 years. Investment opportunity B would pay us a 40% rate of return on investment over 5 years. Notice that 50 is greater than 40. Anybody would rather have a 50% rate of return on investment than a 40% rate of return on investment, unless, of course, it took twice as long to get the 50% as it did the 40%. Therefore, what we need to do to adjust for the differences in what economists call the time horizon of an investment, that's referring to the length of time it takes for the investment to pay all of the return, we need to compute the average annual rate of return on investment. Now let's look at opportunity A. A total 50% rate of return over a 10-year period. Now if we were to divide 50%, the total rate of return, by the number of years, we would find that what we would receive is a 5% rate of return per year on average. Now there's no theorem that says the return every year is going to be equal year after year, particularly when you're buying stocks. Not so much the case when you're buying bonds. You can pretty much count on an annual rate of return. But when you're buying stocks, the returns might be all over the place. One year you'll get high dividends, one year you'll get low dividends, whatever. In the second investment opportunity, where we would get a 40% total rate of return over 5 years, if we divide 40% by 5, we would see we would get, on average, an 8% rate of return per year. For that reason, then, to give us a clearer picture of what our yearly rate of return will be, we need to compute the average annual rate of return on investment.